I follow Morgan Housel on Twitter, as I'm sure a lot of others do as well. And he wrote a very interesting piece 3 days ago, which I thought was pertinent to just bring as we wrap up First Word today. His centerpiece of the thing that is written is that developments that you do not see coming are the biggest risks to market. For him, Morgan Housel, risk is what you don't see. And let me just walk across and try and tell you some key excerpts out of the note that he has written. So, biggest economic risk is what no one is talking about. Now, why does he say this? Because he draws a parallel to what the last 2 or 3 years have been like in terms of assumptions that the market has had. And this is predominantly for the US markets, but you could argue that it could be holding true for the world as well. And I'll draw the India parallel out here too. Firstly, in 2018, the biggest risks that were cited were interest rate hikes and trade war, right? They didn't quite move the needle on the market. 2019, the big risks that were cited, again, trade war and the impeachment of Donald Trump. And we've seen what the markets have done in 2019. So these risks haven't really bothered the market too much. Maybe intraday or on a weekly basis, the markets may have corrected, but not otherwise. And that's what he's saying, that in 2020 as well, trade war and the impact thereof is being cited as the biggest risk and elections as the other one. And according to him, since trade war has stayed as a constant, maybe the inference that I'm drawing from that piece is that maybe that is not a risk that will move the needle on the markets too much. Maybe elections won't either, because everybody's already baking in for the elections. So the risk might actually come in from something that is totally unexpected. And that is something that you got to keep in mind. Now, why is he saying that the trade war may not be the biggest risk? Also because the market is likely prepared for it. He says in his note that that Google News cites 8.4 million mentions of trade war in recent years. That's the quantum of research and understanding that has gone into trade war, or the reading that has got into trade war. And therefore, people might be worried, won't be surprised in the eventuality of the trade war not going as per what the risk-averse investor would want to, and therefore Morgan Housel believes that this might not be a big deal. Now, and he cited a few instances in the past years wherein what has spooked the market is something that wasn't quite on top of the mind of the market. So the Lehman Brothers' inability to find a buyer was largely the bigger thing that led to the fall in 2008. 9/11, completely unexpected, led to a crash and completely unanticipated. Iraq invading Kuwait or the 1973 OPEC embargo are all unexpected events. Now, I'm trying to draw a parallel to what happened in India in the last short period, say maybe 2.5, 3 years. And let's try and see. So what happened? I mean, to all of these times when the markets came off, they came off because of unexpected events. Demonetization, nobody had a clue, and that brought the markets down. Budget 2018 and the reclassification and the introduction of tax, I don't think too many people anticipated this, and which is why that disappointment led to the markets coming off. RNFS was, nobody knew about RNFS, frankly. It was a completely unexpected thing, and that brought the markets down. Similarly, Budget 2019, why everybody was rejoicing after the NDA was voted back to par, the budget came as a bit of a surprise, a bolt from the blue with regards to certain components, including the FPI surcharge, and that led to the markets coming off as well. So even in India, the last small corrections that have happened have all happened, or a meaningful correction that has happened, have all happened because of unexpected events. And therefore, I'm taking it back to Morgan's note for two things that he believes people can keep in mind or practice in order to be better prepared. And yeah, be prepared is the first thing. He's saying think of risk the way California thinks of earthquakes. Just be prepared, believing that this could happen at any point of time, and take a wide berth. By this, he means that if you believe that a risk could bring about a 20% drawdown, you should prepare your portfolio for a 40% drawdown so that it doesn't impact your day-to-day livelihood. So that's something that stood out for me as well. Both of these points about how to prepare yourself for risk and the fact that the risk is something that you are not completely prepared for. A pretty interesting piece, and thought I should bring it to you here.